Hello there, welcome to another video on investing in stocks. Bringing you a general topic video today, just my quick thoughts on timing the market. Wouldn't it be great if you just knew when the market was going down and when it was going up? Now, timing the market is something I've never tried to do and I never will. And here are some of the reasons why. And I think this is a very good timing because we're in a time of great volatility. And there are lots of people out there who think they know when it's going to go down, when it's going to go up. And this is just a quick reminder that you don't. I don't, and no one does. So, first of all, I can't predict the future. And I'm not going to base my investing on trying to do that. It's impossible. No one has ever been able to. Now you might say, well, investing in stocks and picking stocks is in a way trying to predict the future. It's really not. It's an educated guess because I look at the stock market and I see that it's been going up forever. Since the start of the stock market, it's been going up over the long term. And great companies go way more up than the rest. This we know. And based on that, I can say with a very high level of certainty that the market will keep going up. That's why I invest in stocks. Now, the stock market for the last 80, 90 years or so, the S&P 500 has gone up 66% of the time. So 2/3 of all years has ended in the green. Now, you might say, well, if you can predict the bad years, you're going to make a lot of money because when the stock market goes down, it goes down really hard. It goes down more than when it goes up. False. The average green year has moved more upwards than the bad years has moved downwards. So that's actually a myth. So not only does the stock market go up 2/3 of the time, it actually goes more up than it moves when it goes down. But, of course, sometimes we have these big events in the stock market. We call them corrections or recessions, which are basically crashes. So just about every 12 months or so, we have a correction. Correction can be a move at around 10%, 10-15%. A 5% is probably also going to be called a correction these days. And every 10 years, so once every decade on average, we have a crash. So a lot of people betting on the stock market going down, they come back year after year with a prediction of a crash. But according to statistics, if you're predicting a stock market crash, there's almost a 90% chance you're wrong. What if this year is going to be the crash? Well, most likely not. And just because we haven't had a crash in so long or we haven't had a correction in that long doesn't mean it's going to happen. So you are betting against the trend and against history. Now, furthermore, if you do find these corrections or these stock market crashes and you can predict them, my first question is, do you know how to profit from that? But the second one would be, so if you think you can predict a crash or a correction, my guess is that you can also guess when the bottom has been hit. Good luck with that. Now, a lot of stock bears out there, people who think the stock market is a fraud or is for suckers or it's going to crash. You might be grinning your teeth in frustration and saying, look, if you're talking about predicting the future and it's impossible, you never know which way it's going to go, why are you going long stocks then? Well, it's obvious. You look at all data available to you, it tells you go long stocks. It's not just that stocks mostly go up, they go up more than all other investments. Real estate, bonds, commodities, gold, you name it. Now, the burden on proof is on the bears, the people who think the market is going down. You have to present a lot of good arguments for your case for me to buy it, because again, you're betting on a very unlikely event, even when it comes to corrections. Now, there's one number that should stick out to you, and that has always fascinated me, and that is the number that over the last 20 or 30 years, the average return of the stock market has been about 8%, but the average return of the average investor has been 2.1. Now, part of this is a lot of fundamental mistakes being made, but one of those mistakes is thinking you can time the market, getting in and out of trades when you feel the stock market is going down or up. So I'm taking that number and I'm interpreting it that saying, yes, people are picking bad companies, they're paying a lot in fees, they're investing too little at a time, but I think they also are making terrible timings. And to avoid only making 2.1% a year when the market is doing 8%, which is almost a feat in my opinion, it's almost an achievement being that terrible at investing, you just need to pick great companies. Great companies will do well in flat market conditions and trending upwards market condition. They might lose some value in a bear market, but they will lose less than the bad companies. So if you're investing in a good company, you will be making money in almost all market conditions, apart from these unlikely events, rare events such as corrections and recessions. Now, I know a lot of people are watching companies. They're watching stocks for that golden opportunity or timing to invest. And what you're doing, and my guess is that you've already got stuck on the bench, stuck on the sideline with all your cash, waiting to invest, but the market is running away from you. And the more the market goes up, the less you believe it's going to keep going up, and it's going to be a repeating cycle where you don't want to invest when stocks are going up because you're afraid they're undervalued and they're going to crash, but when they go down, you're afraid it's going to crash and burn. So you never actually get to invest, and you lose out on the potential 8 to 10% return every year. So get invested regardless of market conditions. If there's been a crash, if there's been a recession, that's a great buying opportunity. So jump in on that. Now, to end off, I will say that your number one enemy and the worst mistake people do in stocks, this is the number one no, is trading on emotions, letting emotions take control of your investing. Whether you're buying, selling, looking at companies, looking at ETFs, whether you're a long-term investor, whether you're a short seller, you're looking at whatever. When you're trying to time something, you're inevitably going to let emotions take control. And your brain, your emotions are going to tell you to do the opposite of what you're supposed to do. In investing, you need to buy low and sell high. So you need to be greedy when others are fearful and the other way around. But your brain is going to be telling you the opposite. When things are going great, stocks are going up, you're like, what could be wrong? Look at all these great news, these great numbers, it's going up. I want to get a piece of that. But when things are going down and people are getting scared and people are panicking, there's a lot of bad news coming out of the bushes, you definitely don't want to be a part of that. And you're like, maybe this is the next big crash, I'll sell before it does. But again, in 9 out of 10 cases, you're going to be wrong. Now, once in a while, you might be right, but that doesn't weigh up for all the times you've been wrong. Don't let your emotions control your investing. Find great companies performing well, buy them regardless of market condition, and hold them forever and become a great long-term investor. Now, have a great spring. This is the first sign of spring I've seen. That's why I put on this shirt. Have a lovely weekend and week, and I'll see you in my next video.